Nathan Schroeder, come on down. Nathan is principal at Empire Valuation. As I mentioned earlier, Empire, we thank them so much because they have been part of this conference for the last 19 years. They have been a sponsor, a speaker, and have been part of our practice for that period of time. When it comes time to get that valuation done and the discounts to be locked in, Empire has gone to bat with us, with our clients, and also with the IRS. We've had a number of cases under examination, and they've always turned out very, very well for our clients. So, Nathan.
Thank you. Thanks for the introduction, Lou. All right, the fun stuff, valuation, right? So I'm going to talk about a couple of things here. Valuation practices, you know, how we come up with discounts, how we come up with values for privately held assets and LLCs and things like that. And then also I'm going to touch on the Connolly case a little bit that Lee had actually talked about at length earlier this morning. So who is Empire? Well, just a quick backstory. Our two founders used to work for Chase Manhattan Bank, and they were in the valuation group there. And Chase, the new CEO, came in and decided to divest it and no longer do valuations. And they didn't sell the business. They just said, we're not going to even do anything about this. Well, there was a gentleman in New York City and a gentleman in Rochester, New York, and they were getting clients calling them, reaching snail mail back then, you know, sending checks in, please do our valuation, our company valuation. So these two gentlemen, they went to Chase Bank and they said, you know, hey, these clients are sending us checks. Can we run with it? And they said, yes, of course. We don't want anything to do with that. So that's how Empire was really born, and that's why it's called Empire Valuation, as kind of a reference to the Empire State, you know, with offices in primarily New York City and Rochester, New York. We now consider ourselves really a national level organization with offices in San Francisco, you know, Long Island, Boston, Hartford, people in Charlotte, you know, but there's not really any place in the country that we won't touch a valuation. We only do valuation work, business valuation work, intangible asset valuation work. We have recently brought in a real estate appraiser, so we can help with that, but most of the time we need to partner with a different firm or a different person when it comes to art valuations, such as Hunter was talking about earlier from Doyle. Also machinery and equipment is kind of outside of our wheelhouse, so we'll partner with other valuation groups, other appraisers that can do that, as well as real estate appraisers around the country as needed. And because we only do valuation, you know, we're not competing in terms of wealth management or accounting services or trustee services or anything like that. So I think a lot of our partners like us as a service provider because we're not going to step on any toes. And we really have one focus, right? That's delivering a high quality product for the client. And in this situation, most of the time it's estate planning, which means there are certain rules and guidelines you have to follow to submit a qualified appraisal to the IRS, whether it's a gift tax return or an estate tax return. In our trust and estate group experience, you can see on this slide here, you know, we do many estate and trust valuations every year. Everything from privately held operating companies, sometimes divisions even within publicly held companies. They want to know what this division is worth. Obviously, real estate and investment holding companies, so that would be like a LLC or a limited partnership that might have marketable securities. It might have real estate, apartments, various things. Carried interest, which is really profits interest that principals from, you know, private equity and hedge funds and other investment managers may be allocating to themselves as part of their compensation scheme. It's considered more of a complex security. Royalty interest. So one of the nice things about Empire is we're almost 100 people strong, and being that large, you can have people that really specialize in different niches. And for example, we have a principal at our firm who's probably valued more of the top-level sports teams, professional sports teams in the last 20 years than any other valuation firm has. So if you look at like NFL teams that may have changed hands over the last 20 years or 15 years, probably about half of them we definitely have a hand in them, you know, facilitating those transfers. Sometimes they're intra-family transfers, but we have someone that really has a lot of experience within this space here. Same with royalty interest. This is another interesting thing, you know, Broadway shows, music, movies, those things will generate royalty streams for almost into perpetuity, right? Not quite into perpetuity, but we have a team that specializes kind of in valuing that and assigning kind of the risk. You almost have a wasting revenue stream kind of tied to those things. And so evaluating that and the risks kind of around that when they're transferred, whether for estate planning purposes or in a state tax situation. We value promissory notes, split dollar insurance. There's not really anything that we don't value. Again, these are considered intangible assets that are really kind of generating, you know, some level of income, if not today, at some point. So why do you need a valuation? Well, in the estate planning space, right, in the gift tax space, right, you have to have a qualified appraisal. And I'm going to touch on this later in the Connolly case. But if you don't meet that filing with a gift tax appraisal, with a qualified appraisal for your gift tax return or your estate tax return, the IRS can say it's, you know, you don't start the statute of limitations, which is really 3 years from when that valuation qualified appraisal kind of hits their desk, when it's admitted to the IRS. Just a quick overview of our evaluation process. Most jobs or valuations that we do are probably looking at about a 6 to 8 week time frame. And the reason for that is because first we're gathering information, trying to understand what needs to be valued. Then we go out and do additional research above and beyond that. Then we do our own internal analysis. We try to talk to management. The reason why I bring up this time frame, right, is because the sunset potential of the Tax Cut and Jobs Act, that exemption cliff that we're facing at the end of 2025. So historically, when there's an exemption cliff coming, usually by June of that year, we are swamped. And so a typical job that would take us 6 to 8 weeks, we may not be able to turn it around in 6 months. So if you have clients that may need to do this, try to do something in the first half of 2025, because we can't guarantee what the second half of 2025 if you need a qualified appraisal. So what is a valuation, right? So, my favorite example is really looking at a home or a condo or something like that. One person may pay $1 million for that condo or home. Another person may pay $900,000 for it. There's a range of values that are kind of considered reasonable within, the value of something, right? So, but the most important thing is getting to that determination, that estimate, or that determination of fair market value through a reasonable process, right? With reasonable assumptions kind of going into it. What we're usually valuing is obviously the equity piece, right? So if you take the value of something in its entirety, you subtract out the debt, the value of that debt, not necessarily the face value, and you're left over with the equity, right? There's a few different standards of value in the estate planning space and gift tax space. It's fair market value. These are based on Treasury regulations. And it's mainly willing buyer, willing seller in a hypothetical situation. There's some other standards of value, such as fair value, which we do for portfolio companies that are owned by a private equity firm. They need marks every quarter or every year or something like that. And then there's also a fair value dependent on what state you're in, and that there'll be different guidelines kind of around that. Evaluation methodology. So this is where it gets fun. So there's 3 primary ones: income, market, and cost. You can use each of these individually, or sometimes you use them in conjunction with each other in determining what the value of your interest is, or the subject interest is. The income approach is really looking at the stream of income or cash flows that an owner could expect to receive over the life of that investment. And there's 2 primary methods to do that. Capitalization of income, which is basically looking at the historical cash flows or profits that entity has produced, and trying to use that to extrapolate future revenue streams, future cash flow, future profits. So you're really looking at it from a historical basis and extrapolating to the future. The other is the discounted cash flow method, is really a forward-looking analysis where you work with management and they develop really a 5-year or a 10-year kind of lookout period Most companies will do at least a 1-year budget, so sometimes we have to work with management to kind of help expand that a little bit. And that's really capturing kind of the future expectations of what are going to happen. In theory, if you apply both of these methods, you really should you should result with the same value, same resulting value. So if in a case where there's a situation where there's a big divergence in the two values, maybe it's, for example, the discounted cash flow, the future cash flows for the next 5 years are hockey sticking up or something like that. Well, in the earnings capitalization, maybe you have to apply a much higher growth to that for a period of time to kind of capture that. So in theory, they should work out to be roughly equivalent. The market approach is a little more common. It's just saying, I own a hardware store or a chain of hardware stores, and I'm going to look to what Lowe's and Home Depot are priced at and take comparable metrics, maybe revenue or profitability, and say, they are trading at maybe 10 times profits or something like that, or EBITDA. So that's a way to extrapolate kind of an implied value for your entity. If it's a really kind of a pure play comparable situation. This gets a little risky, especially in the gift and estate tax world, because if your comparable companies to your subject interest to the publicly traded companies are not really perfectly aligned, you really should not use this method at all. You can also look at guideline transactions. So those are price points that companies have transacted in the marketplace. Most of the time, these are private companies, maybe being acquired by a public company or something like that. So there's some information out there, but a lot of times you have to take the implied multiples from those transactions with a grain of salt, because there may be synergistic benefits that are being priced into it. But again, these are all, sometimes in the estate planning space, what we'll do is we'll use the market approach as kind of a reasonableness test to test what we came up with from the income approach to make sure that that's a reasonable resulting value. Cost or asset approach. So this is really just taking a bunch of maybe of marketable securities held in an LLC or something like that. It's really just combining them, taking the market price, if there's real estate, inputting the real estate appraisals value to that LLC. And this is really what we see a lot in the estate planning space, right? Where people are putting assets into an LLC or limited partnership, and then the restrictions within that LLC or limited partnership will drive additional discounting that we can apply. And that's especially what Lou and team really look for from Empire. So it's a simple approach. And again, sometimes these are used in conjunction with each other. For example, maybe we have an operating company that has a life insurance policy, similar to the Connolly case, right? What we'll do is sometimes we'll disaggregate that asset, or it could be a group of assets, from the operating value of the company, and we'll treat that almost on an asset approach basis, and then add it into the resulting value for the operating company later on. Just some general factors affecting valuations, obviously profitability, the industry, management, kind of the outlook for the company on a micro level as well as macro level. Other factors that can kind of go into affecting it, the risk-free rate has a big impact on what the values of things are, as well as widely accepted small stock premium or equity risk premiums. And then anticipated tax changes too is a big thing. So if the corporate, for example, if the corporate tax rate drops down to 15%, that essentially means higher cash flows across the board, perhaps into perpetuity for these businesses, and that will obviously have a material impact. I think we've all seen the stock market has priced that in almost right away. So for business owners, why would they need a valuation? Maybe it's because there's an exit strategy, or maybe it's because they're trying to understand kind of their growth options. These exit strategies are obviously a lot of what we're discussing here today. Estate planning, estate tax, sometimes even a sale to an ESOP, which is really kind of moving the company from a couple of owners to an ownership trust that all the employees get to participate in. So one of the things we really emphasize at Empire, especially with an operating company, is understanding what the company's story is. Like, why does it do what it does so well, or what's negative about it? Where are the competitors in the space? And all of these, business cycle sensitivities, the life cycle stage of the company. Xerox is very different now than it was, 20 years ago, for example. Different levels of value. You can value something on a controlling interest basis, which means someone has the ability to sell, make executive decisions such as compensation decisions. Most of the time, especially when we're valuing the LLC that has the 98% non-voting interest from the pure law firms chart, we're valuing essentially a non-controlling, non-marketable interest, right? And so that's the lowest of the low in terms of equity ownership, lowest of the low in terms of rights and purview. And so we will price that accordingly. There's some market data out there that supports applying discounts to interests such as non-controlling, non-marketable interests. And one of those, the big one, is known as the discount for lack of marketability. So it's really, what would the cost be to translate this interest, the subject interest that we're valuing, into cash or liquidity, right? If you think about it, if you buy Pepsi-Cola stock right now, right, you can liquidate it tomorrow, right? Maybe, you get your cash out immediately, if not 3 days. If your interest is in this limited liability company where you're a minority non-controlling interest holder, you have to get permission from the managing member or the general partner of that to essentially liquidate. And a lot of times the assets underlying it are not as liquid either. And so they're very restrictive. And so with that, what we've done historically is there's these restricted stock studies out there, and restricted stock is essentially stock that's been granted to usually upper level management and publicly traded companies, but they're prohibited from trading it or selling it on the open market for a period of time, 1 year, 2 years, 6 months. But there is a secondary market for it, and those things you can observe the discount to the price that transacts in the secondary market with the current stock price. And so with these restricted stock studies, we see marketability discounts ranging from 15 to 35%, kind of capturing kind of the median. They're kind of all over the place. There are factors that kind of go into this, and a lot of valuation firms have kind of studied this as well. But volatility is a huge factor, the block size, if it's paying dividends, or if the company is profitable. These are things that will really kind of drive what level of observed restricted stock discount was observed in the marketplace. There are other qualitative factors that we consider, especially when considering this 98% interest in this LLC that's been set up, that's essentially non-controlling, non-voting interest. What are the expectations of level of distributions? What information access does it have? A lot of times if you're a minority interest holder in an LLC, you don't even get to see the financial statements. You might just get a K-1. And so that's obviously a detriment to if you're trying to sell it or even trying to understand what the interest is. The most restrictive has transfer and withdrawal restrictions, and that will help kind of drive, if there's no distributions, no transfer withdrawal provisions, that will drive us to the highest level of lack of marketability adjustment that we're really kind of comfortable with. Occasionally we'll use a synthetic put option as kind of a proxy for a discount for lack of marketability. And what is that? That's really just kind of calculating the cost of hedging that asset. And so oftentimes the problem with that is volatility can be a big factor whenever you're using a put option or any kind of option for pricing purposes. Okay, so switching gears a little bit to the Connolly case. Lee covered this a little bit. I'm going to rehash a couple of things, but then I'm also going to highlight what we as a valuation firm found really important. So really the big issue here is can life insurance should life insurance be included in the business value, especially if there's the presence of a buy-sell agreement, right? The life insurance was paid to the corporation then used the proceeds of that to buy out the decedent's or the estate's shares in the company. There's some arguments out there that this might have been a bad facts case because the company didn't follow the buy-sell agreement correctly. And the IRS also believes it violated Section 2703, which on the next page here is really when it's an interfamily buy-sell agreement. And so the IRS can say that it's not valid because it's not comparable to what two third parties might implement in a buy-sell agreement. And so from attorneys and estate planning advisors that I've talked to, they consider this is really difficult to prove if the IRS challenges the buy-sell agreement if it meets the 2703 requirements. So expanding on the Connolly story just a little bit, my eyes were drawn to this right away. When they filed the initial estate tax return, they did not attach a qualified appraisal to it. And that may have been what opened up the door to the IRS poking around and looking at it a little more. And then during the IRS audit, what was interesting is the taxpayer hired an outside accounting firm to come up with a value, came up with a value almost identical to what the stock purchase price was. And they included some money from the insurance proceeds, but they left out the $3 million of insurance proceeds that ended up being used to purchase the stock. There's a prior court case that kind of allows this to happen, and it's the estate of Blount versus Commissioner, and that they essentially said that you could use a redemption obligation to offset the value of that insurance. Nonetheless, the IRS, and that's what the accounting firm followed at that time, the IRS decided, nope, you can't do that. And they just added the $3 million proceeds to the value of the valuation that the accounting firm came up with at $3.86 million. So the Eighth Circuit and the Supreme Court obviously agreed with the IRS. We know that now. In the Eighth Circuit Court, what was important there is they actually found the buy-sell agreement to be adequate. However, the family didn't follow it. They were supposed to get an outside firm to appraise it, and they just made a handshake deal on the purchase price there. It was probably tied to how much those insurance proceeds were, if you're reading between the lines here. So in the Supreme Court case, they didn't really analyze anything except whether that buy-sell agreement should be treated as an offsetting liability to the insurance. And we all know now that they decided that it wasn't. And the main reason for that is because if someone were to come and buy the company and buy 100% of the company with those insurance proceeds expected to come in, the seller would expect to be compensated for that $3 million. And that's what kind of drove their conclusion right there. So there are some other issues that we discovered kind of digging into this case a little bit. There's some impacts of this case, right? Obviously, the estate ended up having a much higher estate tax bill. I think they owed $900,000 in addition to what they had paid previously. There's usually fines associated with that. This may lead to more disputes with the IRS over valuation methodologies. Businesses really need to revisit their buy-sell agreements and how they're treating the insurance. And so that's why Lee kind of covered it this morning. It's really important to not let that drift, I guess. Change your insurance proceed or strategies for these operating companies that have these buy-sell agreements. Lee talked about cross-purchase agreements. There's also the option of using a life insurance LLC. And from our perspective too, maybe there should be more gift ownership transfers during the lifetime of, and that's really estate planning, and that's what Hero Law Firm here really helps out with. So from Empire's perspective, we have historically valued life insurance policies in two ways. The main way is we will usually treat that cash surrender value as a non-operating asset. And this is in estate planning purposes and gifting purposes. Less typically, we'll determine if that's not available, we'll use the IRS mortality tables, come up with an estimated lifetime or years until those proceeds may come in, and then discount that to come up with a present value for the expected proceeds, right? And that discount rate is supposed to take into account that, you know, maybe the IRS mortality table expects someone to die in 5 years, but you know, there's a risk they outlive that. They live 10 years or 15 years or something like that. So the discount rate is supposed to take into account that. For estate tax valuation, a lot of times, most valuation firms would fully offset those proceeds with the buy-sell agreement, as was done in the Connolly case, right, by the taxpayer. Post-Connolly, you can no longer do that. But one of the things that was raised in this court case was valuation timing. So the exact timing of the valuation for an estate tax is really important. Is it the moment prior to death, moment at death, or the moment after death, right? And so in this ruling, the 8th Court Circuit talked about the valuation at the moment after death. Now we, Empire, have historically valued things for estate tax purposes at the moment before death. And so this changes the calculus a little bit. The Supreme Court did not actually rule on this. And so it's still kind of up in the air, but it's a question we now have. The implications are pretty profound. So you guys remember Hugh Johnson was up here talking, or was walking around talking. His company is Hugh Johnson Advisors, Hugh Johnson Economics, right? Well, what if he dies? How should we value his company? He's the name. He's everything really to that company. So maybe the moment that he dies, there's really no value there because he has all the relationships, it's his name. And that's why historically we have valued assets for estate tax purposes at the moment before death, really. Death is not predictable. And so, you know, what if all the customer relationships are with the decedent? You know, what is the value of Hugh Johnson's, you know, economics and advisors if he passes? So again, this timing question wasn't addressed, and they really only looked at the redemption obligation at the Supreme Court. So I think that this might be an open issue for later on. So there are some other, you know, on the valuation side, why didn't they take into account the other life insurance policy for the other brother? Why didn't they use other metrics of value, such as that cash surrender value? And yeah, so not everything was resolved there, but happy to take any questions. Okay.
All right.
Thanks, everyone.
Thank you, Nathan.